You're with us here on a fresh new edition of Trading Hour, last session of the week, and the market is, just about all right. It's been a spectacular week again, once again, an up week with over 250 points in it. So a little bit of caution as we wrap up this week perhaps is warranted. Over the next 60 minutes, lots to talk about, lots of themes, the big stories of what's making headlines today, all of it. With me, my colleague Reema Tendulkar. Hi, Reema.
Hi Prashant, good morning. Well, it's the IT stocks which are on our radar, and that's because of the very strong numbers reported from Accenture. So Accenture's Q1 revenues have gone up by 2% on year-on-year basis. If you look at the new bookings, that's the order wins in the quarter, are higher by 25% year-on-year. They've upped the full year guidance. They now expect growth to be 4 to 6%, and it's very rare to see an IT company up the guidance in year one itself. So it just goes to indicate how strong the demand is and the kind of confidence IT companies have. In fact, they are talking about high single to low double-digit kind of growth in the second half of the fiscal year. So the read-through for Indian IT is obviously positive given the strong order wins. But another internal which bodes well is the fact that the outsourcing revenue growth has been a solid 9%. So brokerages are saying, the Macquarie says the demand for digital transformation, particularly cloud, remains strong. Credit Suisse says the pickup in Accenture's revenue growth and order bookings bodes well for the demand environment. They like Infosys as well as HCL Technology. Infosys for its industry-leading growth and HCL Technology on the back of its attractive valuation. Kotak believes Infosys as well as TCS will be at the forefront of the digital transformation. And IT has been the leader of the pack this entire year. In fact, led by Infosys, which has seen an over 60% rally on a year-to-date basis. It's followed by HCL Technology. TCS has lagged behind Infosys so far in terms of its performance this year with an up move of 33%. And that's because Infi has outperformed TCS when it comes to pure growth metrics in Q1 as well as Q2. But for the day, it's a powerful move seen in IT stocks on the back of Accenture's strong performance as well as guidance and commentary. Back to you.
Reema, thanks very much for that. Stocks have had a fantastic run, and Accenture only kind of doubles down on that bullishness that we've seen across the space. We've got one of the foremost IT sector experts with us on the show. Kawaljeet Saluja is Executive Director and Head of Research at Kotak. He's joining us, and we also have Urmil Shah, who tracks the IT services space at IDBI. Gentlemen, thanks very much, both of you, for joining us here on the show. Kawaljeet, first sort of a question to you in terms of what did you make of the Accenture numbers, and is there really a strong read-through for Indian IT services companies?
Well, the results were strong of Accenture, not a surprise. Broadly, there are three trends which are driving growth for IT services companies globally, which is first is a massive investment in the experience layer. Second is a accelerated shift towards cloud, and along with it, incremental investments in core modernization. I think these are the three trends which are driving growth for the IT services industry. Accenture's results, captured some of the themes, and you would expect Indian IT companies to benefit from the same trends as has been seen globally.
The question is how much of it is already in the price. We've seen a strong run-up in the stocks. The valuations are much higher than the historical levels. So, for instance, something like TCS is trading at 28, 29 times forward multiple. Can IT companies positively surprise in terms of earnings as well as the stock moves from here on?
Okay, so there are two questions over there. First is valuations, and second is expectations of performance. So let's talk about valuations first. Trying to rely on historical valuation multiples can be a little bit misleading because there are two shifts that have happened. One is that the cost of equity, has gone down, which is true across most of the sector, most of the markets. Now, the second one is basically the fact that there's going to be an accelerated digital transformation, which means that the transformation that we're looking at for a period of 5 years, 7 years, gets crunched down to 3 to 4 years. Now, that will result in a higher growth rate. So a combination of a lower cost of equity, accelerated growth means that the sector multiples would increase relative to what it was in the past. Within that framework, there are certain companies that have still reasonable upsides over here from the current levels. So the likes of Infosys, even after the 60% run in the stock price this year, has reasonable upside of around 15% from the current levels. Same is the case with Tech Mahindra and other stocks in the market as such. The second question is, your question pertaining to results. I think over there, the demand trends are reasonably robust. And, you would expect that trend to reflect in reasonably good third quarter performance as well, even after taking into consideration the fact that this quarter usually has furloughs.
Kawaljeet, 2 or 3 points, right? One is, of course, Accenture's relative exposure to healthcare, which basically, as many have pointed out, one of the key growth drivers, some 11% growth year on year on a constant currency basis. Second is the currency denomination of revenue costs in light of the stronger rupee. And the third, of course, is that relative to Indian IT services companies, Accenture has underperformed. So how do you look at these 3 things in the context of, and how much we should extrapolate for Indian IT services? I mean, companies here have told us that they have enough tailwinds, the transformation to digital, etc. That is fine. But when we look at these global companies like Accenture, how much do you think the read-through should really be, or should it be a little more measured?
Well, see, over here, you're not basically extrapolating that just because Accenture has reported good numbers. You should extrapolate the same for Indian IT companies. The point, which I'm making is slightly different. It is the fact that there is, accelerated spending there's an accelerated transformation urge across organizations, and that will benefit IT companies. Now, Accenture is a part of that ecosystem, and to that extent, that artificial distinction of Indian IT versus Accenture, at times, I'm not fully able to appreciate that argument. But, the fact is that Accenture is a part of that ecosystem, and what you have seen is Accenture reporting good performance, and IT companies which are listed in India are also a part of that ecosystem, and they will benefit as well. Within that, there will be nuances, like Accenture has high exposure to consulting, they may have a slightly higher exposure to healthcare, and that will reflect, accordingly in performance of different companies. But the point is that the broader theme does not change. And, the point I'm making is that that broader theme of growth will filter through to the performance of, Indian IT companies as well.
Kawaljeet, I want to, go back to the point that you said that using historical valuations is misleading currently, given the low cost of capital, etc. So are the current valuations sustainable? And up until now, most of the rally has been driven by a PE re-rating. Is there scope for further PE re-rating for the IT companies?
See, we value stocks, the sector leaders, at 25 times, multiple. At the next level, we value companies, which is the next 3 companies, which is Wipro, HCL Tech, and Tech Mahindra, at 17 to 20 times. And that's the multiple, which we believe, based on a dividend discount framework and dividend discount model, that's something which we are comfortable with. Right now, I don't think I have a case to make on expanding multiples beyond that zone.
Kawaljeet, but if the indication is that the cost of money will remain so low, cost of equity will remain so low, and prices keep going up, what does one do except raise price targets based on P multiple expansions, unless, of course, earnings themselves pick up to that degree. We are seeing that for pretty much across the market, right?
Yeah. Well, look, I think, if you use the current cost of equity globally for a dollarized business, then, any multiple is justifiable. But what you look at is a simple framework of what the sustainable long-term risk-free rate of return is, add what the risk premium is, and then, discount the earnings. Right now, we are using a cost of equity of 10% for the sector leaders, which is Infy and TCS, to arrive at our multiple. That's what we use. So at a certain point in time, we will take a call on what the right cost of equity is, and that's the number we are working with right now.
Kavalji, thank you very much for joining in. We have Urmil Shah also here with us of IDBI Capital. Urmil, thanks so much for staying by and speaking with us. I wanted to get your thoughts in on the IT sector from here on. We heard about we heard from Kavalji. You can expect the earnings momentum to continue. The demand environment continues to remain strong. But where do you stand? Can this result in a strong growth for IT companies for the next 3 to 5 years? Or what we are seeing right now is only going to result in pent-up demand for FY22. But FY23 onwards, we will go back to a trend growth rate of 7 to 8%. Where do you stand?
Yeah, hi, Ima. Just adding to what Kavalji just mentioned, I believe that regions like Europe as well as Middle East, these are the regions where the digital acceleration and digital transformation has not picked up at the pace at which it has done, in US as well as areas of APAC like Australia and New Zealand. So I believe there is a significant amount of market which is still remaining to be captured. And also, as TCS has been mentioning that we are at the start of the tech cycle, the cloud adoption has, taken place meaningfully. But the other areas like, use of analytics for business growth, customer experience enhancement, these are the areas which I believe have yet not been captured. So according to us, there is a good reason for both FY22 and 23 being a double-digit growth year. And we believe that TCS, Infy, and Tech Mahindra, especially in FY23, should be able to deliver double-digit growth rate on a constant currency basis. So we, in fact, believe that as things pan out, as areas like communication, as well as aerospace and defense, and geographies like Europe and Middle East, the digital transformation there picks up. There should be an upside to the consensus forecast.
Urmil, it's a pleasure. Thank you very much for joining us with those quick thoughts. Appreciate it. Well, Infosys is up 2.5%. HCL Tech is up 2 1/3. L&T Infotech is up 1 3/4. TCS is up 1.7. Infosys is up 1.6. I mean, there is not a single IT stock within the IT services index which is in the red. And this when the market itself is seeing a little bit of pullback. I mean, 35 points lower on the Nifty, 13,706. Well, let's move on from the IT space to the big story that we've been tracking, which is the race for DHFL. It's now effectively down to two bidders, Piramal Group and Oaktree Capital. The creditors of the company are all set to meet today to evaluate the bids, with voting expected to begin next week. My colleague Ritu has been tracking this, and she's joining us to tell us more. Ritu.
Well, today is sort of the D-Day where the evaluation matrix will be presented to the lenders to simply give them an idea of which bid is better than the other, both in terms of qualitative and quantitative terms. As we have been reporting, it's only come down to these two players, Piramal and Oaktree, with Adani's offer being much lower, and SC Lorry, the fourth bidder, is virtually out of the race. And we've also been reporting that Piramal may have an edge because of a few reasons. One, because it offers a higher cash upfront. Second, there is easier insurance business takeover being an Indian entity versus Oaktree Capital that will have to work its way around, find a tenable legal solution, perhaps set up an AIF structure. So that also gives it a disadvantage. And thirdly, also because Piramal Group has offered an additional 10% of whatever banks give to the fixed deposit holders from its own pocket or and above the total offer that it has given to acquire the entire portfolio of DHFL. So all of these factors will be taken into consideration when the lenders finalize this matrix. We're also given to understand that Oaktree Capital, in its conversation with the Committee of Creditors over the past week, has also offered to drop some of the conditions that were seen as some of the hindrances in selecting it as the bidder, even though it was highest bidder, even though it had offered a little more. For instance, the insurance business takeover had a sunset clause of March 31st. Perhaps that may be removed. The holdback sum of 1,500 crore may be reduced. So there are ways in which Oaktree is trying to see if it can make its offer more attractive. We're also given to understand that Oaktree has been worried that lenders are showing a preferential treatment to the other bidders, and it was mulling legal action. But so far, we're given to understand it hasn't really taken any concrete action on the front. Perhaps it's just posturing at this point of time. We'll have to see. But the lenders meeting is slated to start at around 3 p.m. So we'll find out at the end of the day what the lenders finally decide and then begin the voting next week.
Thanks, Ritu, for that. Yes, an important meeting coming up today with the Committee of Creditors on Divan Housing. We'll be tracking that very closely. We'll slip into a very short break. On the other side, commodities editor Manisha Gupta will put the spotlight on silver. Silver has seen a rally of 38% so far this year. More details in the outlook on the other side.